Bitcoin has generated more wealth than almost any asset in modern history. It's also generated more fraud. And if you look closely enough at the numbers, you start to realize those two facts might not be separate. They might be the exact same mechanism wearing different masks. In 2025, cryptocurrency scams pulled in at least $14 billion on chain. That's not total crypto value. That's just the confirmed scams. The FBI documented a 58% increase in crypto fraud losses from the year before. But here's what nobody talks about. Those scams don't exist in isolation. They exist because Bitcoin's structure makes them possible in ways traditional finance never could. Let me show you what I mean. Right now, roughly 7,000 Bitcoin wallets control 58% of all available Bitcoin. That's not 7,000 people. That's 7,000 addresses. And addresses can belong to the same person, the same fund, the same criminal organization. 4 addresses alone hold over 600,000 Bitcoin. The next 82 largest holders control another 2.1 million. Do the math. Less than 100 wallets control 14% of the entire supply. A 2020 Bloomberg analysis found that 2% of accounts control 95% of all Bitcoin. The system designed to decentralize money has created the most concentrated wealth structure in financial history. And unlike traditional markets, where we at least know who the major holders are, Bitcoin's pseudonymity means these whales operate in complete darkness. You're probably thinking that's just early adopters getting rich. Fair enough. But here's where it gets interesting. These whales don't just hold. They move markets, and they do it in ways that would land traditional traders in federal prison. Wash trading. You've probably never heard of it. It's when you buy and sell the same asset back and forth to yourself, creating the illusion of demand. In regulated markets, it's blatantly illegal. In crypto, it's Tuesday. Research from 2019 found that 95% of Bitcoin's trading volume on unregulated exchanges was fake. I'm not exaggerated. Fake. Created through wash trading. Academic researchers got their hands on leaked Mt. Gox trading records. They found over 115,000 wash-traded transactions involving nearly 3,000 distinct trader IDs. The scale wasn't accidental. It was systematic, industrial. And it worked because Bitcoin's structure makes verification nearly impossible for average investors. When legitimate trading volume drops, wash trading intensifies. When real buyers show up, the fake volume pulls back. It's strategic, calculated. The FBI ran an operation in 2024 where they created a fake cryptocurrency specifically to catch fraudsters. Within months, they uncovered a $25 million pump and dump scheme. 18 people charged. And that was just one token created as bait. Now imagine that same manipulation happening across thousands of cryptocurrencies simultaneously, with whales who control enough supply to move prices at will, operating through pseudonymous addresses that can't be traced to real identities. But the brilliance isn't just in the manipulation, it's in the cover story. Bitcoin was sold as digital gold, a store of value, a hedge against inflation. Except gold doesn't drop 70% in a bear market. Gold processes thousands of transactions per second through existing financial infrastructure. Gold doesn't charge $50 per transaction during high demand. And gold certainly doesn't consume more electricity than entire countries just to verify transactions. Bitcoin's base layer handles roughly 7 transactions per second. Visa processes thousands. One Bitcoin transaction uses 1,200 kilowatt hours of energy. That's equivalent to 100,000 Visa transactions. The network now consumes 173 terawatt hours annually, more than Argentina, more than Poland. Each transaction emits 672 kilograms of carbon dioxide, the equivalent of driving 1,600 kilometers in a gas-powered car. And unlike transaction capacity, which is capped, energy consumption has no ceiling. It scales with price. The higher Bitcoin goes, the more energy gets burned. There's no physical limit to how destructive this can become. Former British Prime Minister Boris Johnson called Bitcoin a giant Ponzi scheme in his Daily Mail column. His reasoning was simple. Cryptocurrencies depend on belief rather than intrinsic value, and prices rely on new investors constantly entering the market. Bitcoin defenders responded that Ponzi's have central operators and promised returns. Bitcoin has neither. Just code and mathematics. They're technically correct. Bitcoin isn't a Ponzi scheme. It's something more sophisticated. Academic research describes it as a negative sum game. In a Ponzi, money from new investors pays old investors. In Bitcoin, money from new investors pays old investors. But mining also consumes electricity and hardware. The system burns value just to operate. Every transaction, every block, every validation costs real resources that disappear forever, which raises an uncomfortable question. If the early holders control most of the supply, if the trading volume is mostly fabricated, if the energy cost makes small transactions economically impossible, and if the entire system requires constant new money flowing in just to sustain current prices. What exactly are people buying? That's where the real genius reveals itself. They're buying the narrative, and the narrative was engineered from day one. Satoshi Nakamoto vanished in 2011. Whoever they were, they mined approximately 1 million Bitcoin in the early days when mining was trivial. At current prices, that's tens of billions of dollars in holdings. Those coins have never moved. They sit in wallets everyone can see but nobody can touch, the most valuable dormant fortune in human history, held by an identity that doesn't exist. That absence is the cornerstone. No founder means no central authority to prosecute, no CEO to subpoena, no board to regulate. The system can't be shut down because there's nobody to arrest. It's brilliant legal architecture disguised as libertarian philosophy. And it created the perfect conditions for what came next. Early adopters accumulated massive positions when Bitcoin traded for dollars or cents. By the time mainstream investors arrived, those early holders controlled the majority of supply. Now look at the distribution. Approximately 60% of all Bitcoin sits in wallets controlled by 0.01% of holders. 4 addresses alone contain over 600,000 Bitcoin. The next 82 largest holders control another 2 million. This isn't decentralization. It's the most concentrated wealth distribution of any tradable asset in existence. And because every address is pseudonymous, these whales can coordinate without detection. They can move markets, create artificial scarcity, and manipulate prices while remaining completely invisible behind cryptographic addresses. The blockchain shows every transaction, but it can't show who made them. That gap between transparency and anonymity is where the entire scheme lives. Here's what happens when you combine concentrated ownership with fabricated volume and limitless new investor money. Whales accumulate during bear markets when retail investors panic sell. They distribute during bull runs when mainstream media coverage brings fresh capital. The cycle repeats. Each iteration transfers wealth from late buyers to early holders, and the system ensures there will always be late buyers because the narrative keeps evolving. First, it was digital cash, then it became digital gold. Now it's an inflation hedge, a store of value, the technology of the future. Each narrative attracts a new wave of investors who believe they're early to something revolutionary. They're not early. They're exit liquidity for people who bought years ago at tiny fractions of current prices. The criminal infrastructure supporting this has industrialized. Cryptocurrency scams pulled in $14 billion on-chain in 2025 alone. That's up from $9.9 billion the year before. These aren't amateur operations. They're sophisticated networks running out of forced labor compounds in Cambodia and Myanmar, where victims of human trafficking execute massive fraud campaigns under coercion. AI-powered deepfakes now account for nearly 40% of high-value crypto frauds. A fake Elon Musk livestream collected $5 million in 20 minutes before vanishing in early 2026. Bitcoin, ATMs have become such effective fraud vectors that over 80% of transactions above $10,000 are now connected to scams, according to Massachusetts authorities. The FBI created a fake cryptocurrency specifically to catch these operations. They called it Nex Fund AI. Within months, they uncovered a $25 million scheme. 18 people charged. That was one honeypot token. Now consider that thousands of cryptocurrencies operate simultaneously with zero oversight, backed by the same manipulated infrastructure. And the environmental cost keeps compounding. Bitcoin mining now accounts for 0.78% of global electricity consumption. The network burns through 173 terawatt hours annually, while renewable energy that could power homes instead gets redirected to validate transactions nobody actually uses for daily commerce, because that's the final layer of the scheme. Bitcoin doesn't function as currency. Transaction fees spike to $50 during high demand. The network processes 7 transactions per second, while traditional payment systems handle thousands. Nobody's buying coffee with Bitcoin. They're buying the idea that Bitcoin will be worth more tomorrow than today. That's not a currency. That's not even an asset. It's a distributed narrative that only holds value as long as new believers keep arriving. And the structure ensures they will because the early holders have every incentive to keep the story alive. The exchanges profit from volume, whether it's real or fabricated, and the media generates clicks from price movements in either direction. The genius isn't in the technology. The blockchain is elegant but impractical for its stated purpose. The genius is in creating a system where every participant has an incentive to recruit the next participant, where the structure makes prosecution nearly impossible, where ownership concentration remains hidden behind pseudonymity, and where the narrative adapts to whatever story brings in fresh capital. You're not buying a revolution, you're buying a position in the most sophisticated wealth transfer mechanism ever constructed, one that runs on code nobody can shut down, controlled by holders nobody can identify, sustained by narratives that shift with every market cycle. And it only works because the people buying today believe someone will pay more tomorrow. That's not innovation. That's the oldest game in finance, rebuilt for the digital age with just enough technical complexity to obscure what's actually happening. The math doesn't lie, the incentives don't lie. Follow them to their logical conclusion, and every piece fits. The system was never broken. It was designed exactly as intended, a structure where early holders accumulate massive positions, where trading volume can be fabricated without consequence, where energy consumption has no ceiling, and where new investors perpetually fund the exits of those who came before. Every element serves the same function. Transfer wealth from those who arrived late to those who positioned early. Bitcoin supporters will say this analysis ignores the technology, the innovation, the potential. But the technology is irrelevant if the economic structure underneath it operates as a mechanism for extraction rather than value creation. And the numbers show exactly that: concentrated ownership, manipulated markets, unsustainable energy consumption. A negative sum game that burns resources just to validate transactions nobody uses. The question isn't whether Bitcoin is a scam. The question is whether you can see the structure clearly enough to recognize what you're actually participating in, because the system doesn't need everyone to lose. It just needs enough new participants to keep the cycle running. And it's been running for 15 years without interruption. The blockchain is transparent. The incentives are transparent. The wealth concentration is transparent. Everything you need to understand what this actually is sits in plain view on a public ledger. Whether you choose to look is up to you.